Hi everyone, this is Sandeep Anand. 2020 and 2019 has returned tremendously for people who have stayed invested in the markets. Some of the stocks have returned 7 times, 8 times, 10 times, 30 times, 40 times in the last 1 year, 1.5 years. The most important question looming in everyone's mind today is, shall I book profits? Or shall I book partial profits? Or shall I add more money to these stocks that has run up a lot? Is there still potential for the market to go up? With the gush of liquidity and the neutral stance from Fed, is there a possibility, because most of the analysts are predicting next 2 years to be bullish and expecting more returns from the stock market? That's a global phenomenon. But there is also a caution or word of caution that I want to bring in here, where there is a new generation of millennial population, especially the Robinhood traders. And there is this famous expression that is running around the market that stocks only go up. Yeah, I mean, what if the stock market corrects into a bear territory? It could be I will lose 20% from the top. And what if it even gets into a recession? It might correct 30%. Now, I'm okay with a 30% correction from this level because most of us have got phenomenal returns in the last 2 years in the markets. But that's not really the case. I want to help you here to bring out a presentation and showcase, execute my point in terms of there are 5 scenarios I'm bringing in here that has happened globally in different countries, different parts of the world, where the stock market corrections has been really brutal and has wiped away the hard-earned savings of millions of investors in the past. So the 1929 Great Depression, so-called, it was a depression, not even a recession. That you could see that the Dow Jones Industrial Average increased sixfold. That is, the index increased, multiplied sixfold from 63, that was the index price in August 1921, to 381 in September 1929. And after this, such a big run up of index multiplying 6 times, so one can imagine how many times the stocks or individual stocks would have multiplied. And at the peak in 1929, Irving Fisher, one of the greatest economists in US, made a statement like stock prices have reached what looks like a permanently high plateau. And this was just before the crash. And in 1929, October 28th and 29, the Black Monday and Tuesday, Black Tuesday, where the market fell by 25% in just a couple of days. That's one fourth was wiped out. By mid-November, that's in another 1 month, the market lost 50% of its value from the peak. The slide continued through till 1932, that is 3 years later, when the Dow closed at 41, that is down 89% from its peak in 1929. So 3 years later, the Dow lost 90% of value, and that's an index. And Dow did not retouch this peak of 381 that happened in 1929 until again till 1954. So markets literally stood the same place for 22 years, and it gave zero returns for people who had heavily invested at the peak of the market. The next interesting case study is something we can all correlate because it has happened recent past. So in 2001, the dot-com bubble, which we all have heard or some of us have invested during that time, the Nasdaq bubble was looming, and it was like in 1996 when Nasdaq was trading at around 1300 levels, when the then Fed chairman Alan Greenspan came and called out in public, this is a period of irrational exuberance, and there is an asset bubble is what he quoted in the public media. And from that point, the market did correct a bit, but then it continued its stride upwards. And the next 4 years until 2000 March, when Nasdaq hit the peak, it went up 4 times. So 1300 when Alan Greenspan came and said that in the public that there is an asset bubble. From that point, it multiplied 4 times. The highest point of Nasdaq was on March 2000 when it hit 5132, 5132 levels. Then by October 2002, in next 2 years or 1.5 years almost, the index had fallen by 80% to levels of 1100 again. So it took after that 2002 almost 12 years for the market, for Nasdaq index to climb back to its 2000 level. So only in November 2014, Nasdaq hit back that levels of what it was in 2000 March levels. So investors who had heavily invested at the peak of the Nasdaq boom when it was at 4,800, 5,000 levels, literally got no returns for the next 17 years, inflation adjusted. For next 17 years, it was zero returns by Nasdaq. Yeah, the next interesting case study is very recent past. We all have invested during that time in 2008, Great Recession. So the market hit the peak in 2007 October, and from the next five trading sessions were lower for DJIA Dow Jones, and it closed lower in all five sessions from the peak of 2007 October. And by March 6, 2009, the Dow Jones had dropped 54% to 6,400 levels from its peak of 14,000 levels in October 2007. So, in a matter of 1.5 years, that is 17 months span, the the market Dow has corrected 54%, and the index returned almost zero. That is from for next 5+ years, from 2007 all the way to 2012. Returns were zero for people who have invested at the peak in 2007, and it would have really tested the patience of investors. Now, the next interesting case study is the Japanese asset price bubble. This has happened, a specific country specific risk with the Nikkei index. Many of us would have heard about it, but here is a quick review or refreshing session about the Japanese asset price bubble. So the Nikkei index, 225 index, hit the highest peak in 1989, that is December 29, 1989, climbing up to a record high of 38,900 levels before the bubble burst. It was a frenzy speculative buying all assets, including real estate in Japan. Now, at their peak, the prices in central Tokyo were such that the Tokyo Imperial Palace grounds, the residence of emperors, were estimated to be worth more than all the land in the entire state of California. Such was the exuberance in the real estate and even stock market in Japan. Now, it took 30 years for Nikkei to recover to 24,000 levels, which was a value in 1990, not 1989. So it took 30 years for Nikkei to recover back from where it was trading in 1990 levels. And it takes another 60% from the current levels of Nikkei. It takes another 60% up move to touch the all-time high, which happened in 1989. The value was 38,916. So imagine three and a half decades of zero returns on underperformance for people who have invested in the index at the peak, at the exuberance. So much of excess was created in Japanese asset bubble. And here is another bubble, which is 1992, that happened in India. That is with the Sensex. I'm put the graph of Sensex here. On 30th March 1992, the Indian index Sensex crossed 4,000 mark and closed at 4,091. It was then that Harshat Mehta scam hit the markets, and Sensex really witnessed an unabated selling. And Sensex retraced back to the 1992 level again back in 1999. So there was almost a 7 years of zero returns or underperformance by the index, and for people who have invested in the peak of that bull market, would have literally made no returns in the index. Now, I'm not trying to scare away or thwart away the investors, future investors who wants to invest money in the market. All I'm trying to bring is a few key lessons we can take from the history and be prepared for any sort of such corrections that can really wipe out of our capital. The first key lesson is index investing does not work always, which means it works only when you systematically invest money over long periods of time, month on month systematically, or every quarter or every year. If you do it over 15, 20 years, then index investing works because your cost price of the stocks or the index gets kind of averaged out and spread out. It becomes normalized over 15, 20 years, and you end up getting positive returns most of the time. There could be exceptions again. But it's a wise idea to diversify even different indexes. Do not have 100% country risk exposure to one country. It's a wrong way to invest in indexes. You need to have at least a portfolio of indexes spread across different countries, different geographies, different type of market capitalization, which means small size, big size companies, and different sectors across different assets. So you need to have real estate, gold exposure. You need to have exposure to commodities. You need to have exposure to emerging markets. So it should be a wide portfolio of 4 to 5 indexes that can help over 15, 20 years to get 8 to 10% positive returns. The second key takeaway is, always there is no generic rules like, 20% is the only correction that can happen for bear markets. 30% is a max. It can correct when there is a recession. I mean, look, those are kind of lower thresholds, which has been set by the industry experts with their experience. So 20% is the minimum that the bear markets can correct. or to enter into bear territory. 30% is kind of a average out, when a recession happens, but corrections can go much, much bigger than that, as we saw in the 4 to 5 scenarios. And there are many other scenarios like 1937 fall, 1997 Asian economies crisis, or many other scenarios which I have not brought in here for the paucity of time. So every such deep corrections are caused by always a completely unprecedented unknown event, and it strikes when it's least expected, and it's always a post facto cost attribution that most of us do with that fall that has happened. With that, the common theme around all the big corrections that we saw is high asset prices or bubble zones that are created by gush of liquidity. And there is so much of excesses in every scenario we saw. Whenever there is so much of excesses that is created, whatever the causes could be, like liquidity, the corrections can be really brutal, and there could be decades of underperformance ahead. Now, there is a similar exuberance at this point. Again, we don't know how long it can run. Like, it could go 3, 4 years, many years ahead. But the markets, as a famous saying goes, market can remain irrational longer than we can remain solvent. So all we can do is create that margin of safety so that we don't end up losing our hard-earned money and capital. And if we have to invest in indexes, spread out, create a portfolio across different sectors, different countries, as I said, and do it with a dollar cost averaging, which will help us, not not having to time the market, which is really a tough task. So this is all I wanted to present. Hope this was helpful. Thanks for staying with me.